Choosing the right legal structure is one of the most consequential decisions I'll make when developing a business plan. It affects how the business is taxed, how personal and business liability are separated, and how easily the company can attract funding. It can also shape future growth opportunities and administrative responsibilities. The legal structure is not just a filing decision. It is a foundation for how the business operates and evolves. In this presentation, I'll focus on the key considerations for making that choice thoughtfully. Your legal structure is more than a registration choice. It establishes a foundation for how your business operates and grows. It affects your personal liability, meaning how much of your own assets could be at risk. It also shapes your tax obligations, your ability to attract different types of investors, and the amount of paperwork and compliance your business requires. Choosing the right structure early matters. Changing it later can be costly, complicated, and disruptive, so this decision deserves careful consideration from the start. A sole proprietorship is the simplest business structure. One person owns and operates the entire business, with no legal separation between the individual and the business. It's often a practical choice for freelancers, consultants, and early-stage entrepreneurs who are testing an idea and want a straightforward setup. The major trade-off is zero liability protection. If the business takes on debts or legal obligations, the owner's personal assets, including savings or a home, may be exposed. So, simplicity comes with significant personal financial risk. Partnerships can be a strong choice when two or more founders bring complementary skills and want to share ownership and responsibility. A general partnership is typically suited to equal co-founders who plan to participate actively in the business. A limited partnership may be better when passive investors contribute capital and want returns without taking on management duties. Most importantly, always create a formal partnership agreement, even when the partners are close friends. Clear terms can prevent misunderstandings and costly disputes later. An LLC offers three major advantages for business owners. First, liability protection. The LLC structure generally separates the business from its owners, helping protect personal assets from business debts and lawsuits. Second, pass-through taxation means profits flow directly to the owner's personal tax returns, avoiding the double taxation commonly associated with corporations. Finally, LLCs provide operational flexibility. They typically involve fewer formalities than corporations, including no required board meetings and fewer complex record-keeping requirements. Together, these features make the LLC a practical and adaptable business structure. When choosing between a C corporation and an S corporation, the right answer depends largely on your growth plans and tax preferences. Choose a C Corp if you expect to raise venture capital, pursue an initial public offering, or work with international investors. An S Corp may be a better fit if you want corporate liability protection, while keeping the tax treatment relatively simple, similar to a partnership. That option is generally designed for businesses planning to remain smaller, rather than seeking broad outside investment or public market growth. This table brings the main trade-offs into one view. Sole proprietorships and general partnerships are low-complexity options, but both carry unlimited liability. Limited partnerships introduce a mixed liability structure and are suited to passive investors. An LLC offers limited liability with pass-through taxation and is positioned for most small businesses. C corporations provide limited liability but involve double taxation and higher complexity, making them a fit for venture-backed startups. S corporations also provide limited liability and pass-through taxation, though with higher complexity, and are aimed at small corporations. Choosing the right business structure depends on four practical considerations. First, assess your risk tolerance and how much personal financial exposure you're willing to accept. Higher risk generally points toward an LLC or corporation. Next, consider your tax strategy with guidance from a tax advisor. Pass-through structures may suit many small businesses, while C Corp offer distinct deductions. Your growth plans matter too, since venture capital and employee stock options often require C Corp. Finally, with multiple owners, choose a structure that clearly defines ownership, voting rights, and profit sharing. Registering a business involves several important steps. First, choose the right structure, such as an LLC, corporation, or sole proprietorship, and consider consulting an attorney or CPA. Next, file the formation documents, including articles of organization or incorporation when required. Then apply to the IRS for an EIN or employer identification number. Open a dedicated business bank account so personal and business finances remain separate. Finally, check your state and local requirements. Ongoing filings and fees may be necessary to keep an LLC or corporation in good standing. There are 4 common mistakes that can undermine an otherwise sound business structure. First, keep personal and business finances completely separate, because commingling funds can put your liability protection at risk. Second, don't choose an entity based only on taxes. Liability, fundraising needs, and future flexibility matter just as much. Third, professional advice is worth the investment. An attorney and CPA can help prevent costly problems that are difficult to reverse. Finally, treat the decision as an ongoing one. Revisit your structure as the business grows and reaches important milestones. The key takeaways are straightforward. Protect yourself by limiting personal liability and choose a structure that supports your 5-year vision. Get advice from both an attorney and a CPA before filing. Finally, document everything, including operating agreements, bylaws, and partnership contracts, so expectations are clear.